Welcome back. Well, let's look at the next company in focus, and the one that we have on our radar now is Angel One. Of course, Angel One came out with its Q2 results, and there is so much that's been going on in terms of regulatory changes that impacts, of course, broking companies. Let's pull up the one-year performance of Angel as well. The stock has done well, about 50% up in the last 1 year, and the last 2-3 months has seen the stock go on an absolute tear. Still not at its all-time high levels. That level was closer to 3,800, but yeah, it's not too far away from that either. Now, talking about the second quarter performance, revenue, one could argue, was a slight miss compared to some of the street estimates, but there's a big improvement in the operational performance, and that was received very well by the market. The stock really zoomed ahead once the numbers came out. So what is the road ahead looking like? Dinesh Thakkar, Chairman and Managing Director of Angel One, is with us to take the conversation forward. Mr. Thakkar, good morning. Great to have you on the show. We're speaking to you after a long, at least I'm speaking to you after a long time, so to be here. And, we have to talk about the business in the context of some major, regulatory changes that have happened. One, on the flat fee structure, right? The whole slab-wise system is now a thing of the past. It has to be flat fee, uniform, and that's getting rolled out. The other one, obviously, is the F&O landscape is going to change quite dramatically come the 20th of November, right? With the number of expiries being limited and lots of other regulations coming in. Let's first talk about the flat fee, because that's already happened and you've also revised your broking charges. The worry was that this would spell the death of discount broking completely. And we've seen some of your peers like Zerodha come in and talk about that, tweet about that as well. What is the impact on your business in terms of revenue, in terms of the way the charges will be levied? Because now I think even on cash trades, you will have to levy something. Cash transactions can no longer be free.
Yeah, sure. First of all, all regulation which comes in the market, we have seen most probably they look at investors' interest. And whenever SEBI have come out with some kind of this kind of reforms or some changes which helps investors to build trust and confidence, we have big growth in customer base. Now, coming to this true to label, where we have to charge as per what exchange charges us, I don't think discount broking houses were too much dependent on these differential prices. It was because of differential prices we were keeping our prices low, or some services were provided free, because we knew back end we are getting some kind of a commission or some kind of rebate because of scales that we have achieved. But if regulator feels that is not the right model, it should be level playing field. I don't think these platform companies, digital companies, when they are serving a customer is sensitive to some charges to be levied on services what they are taking. That's the reason we went ahead and started charging on cash delivery. And we feel that customers are okay to pay it until the platform is functioning well, glitch-free, and they're able to execute their trades. So we don't see any impact in terms of true to the label, because we have done few changes in cash delivery, and we have started charging on non-cash collateral which customer provide. We charge interest on that.
Okay. So what is, sir, if you could just quantify the revenue impact, because back when we spoke to you, I think this was around July, August, when all of this was being put in motion, at that time the indication was that the impact could be to the extent of 8%. So can you just tell us on revenue, now that you've started with the new charges, what is the net impact on revenue and the impact, if any, on your trading volumes as well?
Yeah, if we come to true to label impact, it was what I had estimated was 8%. And by changes that we have made, it will offset that impact, and we would not be seeing any impact because of true to label.
Okay. Now let's come to the other one, right? That's the big one, which is also new. Mr. Thakkar, good morning. Prashant here.
Yeah, good morning, Prashant.
One weekly option, one contract instead of 3-4 per exchange. Exchanges have been privately telling us that market volumes will drop significantly because of this. Some have said 30%, 40%. We don't know. We'll only find out from the 20th of November. What is your own sense, sir?
See, Prashant, I don't agree that volume would be so drastically lower, because based on kind of an analysis that we have done, total impact on our net income would be in the range of 13 to 14%. Because customer who has decided to come to the market, they will come and they will trade. So they may trade in F&O segment, or they may trade in cash segment. So I'm talking in terms of overall income impact on our total income. But when we come to drop in F&O volume, my estimate would be drop would not be more than around 20 to 22% maximum. But lots of these customers are going to move to cash segment. So we believe that impact on discount broking houses in terms of their gross revenue would not be more than 13 to 14%.
Okay, so 20 to 24% drop in F&O volumes market-wide, right? That is your estimate?
Yeah.
And
Yeah, right.
for you, you said net profit impact could be 13 to 14%.
13 to 14% maybe in 1 or 2 quarters because customer base is growing at the rate of 40, 50%. So we don't see any impact beyond 2 quarters. And one more thing that you keep in mind, when a customer comes to the market, he has certain wallet share for trading and investment. That is going to continue. Because this person will get less opportunity in weekly options, he may stagger this or maybe his life in this market will increase. So overall lifetime value of a customer is not going to decrease. In fact, it is going to increase. If they lose less money, they're going to stay in the market for the longer time.
Is there any way you can offset this? Is there anything you can do or exchanges can do?
Discount brokerage houses can do because we can increase charge per order because we have seen customers are not very sensitive in terms of charge per order, but they're more sensitive in terms of stability of platform. So there is an elasticity, there is an headroom that we have, but we will look at this kind of situation for a quarter or so and then decide whether there is a need to tweak any charges. Because we have seen that previously also, lots of brokerages tried to give 10 rupees per order, but they were unable to get market share because their platform were weak, they were not really user-friendly. So we feel topmost discount brokers have that kind of levers. They can use it if at all they feel impact is beyond what we were anticipating.
All right.
I just had one more question, and this is not with regards to you, but no one really knows, but markets have... So this is with regards to exchanges themselves. Do you think, as an insider, as someone who, of course, knows this business more
in
than anybody
industry,
else,
don't say insider.
Yeah, of course. I mean an industry insider, let me put it that way. So markets are assuming that the one contract per exchange will benefit BSE. Volumes will move, especially on the option side. And they will gain market share. Is that assumption correct? And to what degree in your assessment? This is just purely theoretical, your sense. And we're not going to hold you to it.
It is not going to happen that way. Because we have seen that there is a stickiness on platform. So people who are used to like certain products, they don't shift very easily till the time there is a big drastic kind of thing which they have to do it compulsorily. If you look at contract size was reduced in April 2024, we did not see any big benefit to neither to exchange nor to this thing. So there can be a temporary kind of blip in volume for 1 quarter or maybe 1 month. The people were not aware that contract size has reduced. Similarly, I feel when contract size would be increased, ticket sizes increase and lesser number of weekly option, that is not going to create a big shift from one exchange to other exchange or one broker to other broker.
Because the assumption is that people want to trade. So आपको सट्टा करना है, तो आपको you need a product. So now they will do it. They were doing it on NSE. Now it's not like that. You're saying it won't happen. There's no.
No, people are shifting. It is not that they're shifting because of these changes. They want more product. They want more variety. They will do it.
But this per se will not cause this will not cause a big market share shift on the option F&O side.
Yeah, this option rationalization and ticket size change is would not be an instrumental to change in platform.
Okay.
All right. Hi, Mr. Thakkar. Nigel on this side. Despite all these regulatory changes, you're holding on to your EBITDA guidance of 40 to 50%, right?
Yeah. See, I just look by all these changes, cost of trade has not increased. So if at all, suppose a client does a lesser volume and staggers their volume instead of 6 months to 12 months, we may be having an extra capacity for a quarter or two, which will get filled as I said that, okay, customer base is growing at the rate of 40, 50%. So cost of trade is not going to increase because of these changes.
But sir, you just said that, brokers like yourselves will check for price elasticity and perhaps, like you just said, you'll be charging on the additional margin that you'll provide, etc. So I'm not understanding. I mean, how is it that you're saying that cost of trading is not increasing once, with the True to label?
Surabhi, let me explain. See, digital model have a capacity created for certain volume. And because if there's a drop in volume, which we feel that we would not be able to fulfill capacity in 2 quarters, we need to take some corrective actions because we can't reduce our capacities. But if you look at cost has not increased. If at all, I am anticipating hit would be, say, on exchange 20%. If it goes beyond that, then our capacity would be remaining unutilized for certain amount of time. So we need to do some corrective steps.
Can you just tell us that when you talk about capacity, sir? I got your point that, I mean, you don't want your trading, Angel One's trading volume should not fall beyond a certain threshold, because then you'll have to take those corrective actions. Do you always work on 100% capacity? And what is the trading volume hit that you are anticipating at Angel One as all these F&O changes roll out?
We work on trading capacity. It's a SEBI regulation which says QSB brokers have to work at a capacity of around 50%. So we are working at the capacity of 45-50%. But if at all volume drops beyond what we are anticipating, so we would be running at a capacity utilization of just 30%. If at all it goes beyond what I am saying. Currently, what we are estimating would be a hit of around, say, 20% in F&O, and that will create an impact of 13 to 14% impact on revenue. If it goes beyond that, so we need to protect our margin for that financial year.
All right, very quickly, sir, you're also planning on distributing insurance policies through your platform. What's the timeline for that? Also, just give us some clarity. Would you be competing with the likes of Policy Bazaar? What's your strategy to capture some market share?
Sure. So, as last year, we introduced Super App and we started distributing mutual fund. Today, as we speak, we are number 2 in terms of incremental SIP. This quarter, we started distribution of loan product, personal loans, and we were able to disburse around 360 crores of loan disbursement. So that is where we are very bullish. We think that we'll be able to get a decent market share in that space also. By last quarter, we'll start introducing insurance business, but our model is different. It is purely digital model. We don't have a call center and all that. So we'll sell only products which are fully digitized, which has a digital journey.
Right. Sorry, I'm pushing it with timing, but just one more question since we have you and we only chat quarter to quarter. The other thing which we don't know if it'll happen and by when, but I'm told that beta testing has already started is essentially, ASBA for secondary markets as well, right? If that is implemented and depending on when, etc., what are implications then? Will that require another sort of pricing reset to offset the impact?
Currently, it is too early for us to do any assessment. We have to see systems and what kind of there are 2 kind of an option given to us, 3-in-1 and ASBA. So we have to see that what is the readiness of system, and based on system, which product or which area we have to give options or whether it is mandatory. I think by December, by next quarter, we would be very clear in terms of if there is any impact because of ASBA and all that.
Okay. All right.
But my sense is that that impact would not be very high. So all that kind of very heavy impact things have been announced was introduced in this quarter.
It's all relative, right? So maybe the impact keeps reducing. The big stuff has been done, and
big stuff has been done. I say that. Yeah.
You provided a clear picture on what implications are and how you're thinking about it. Thank you very much, Mr. Thakkar, for joining us with that perspective. It's always a pleasure speaking with you here.